Some of them are still here, right. Now, before I start, I'm obliged to give you a warning that stock market investments can fall as well as rise, and you can end up with less money than you invested, i.e. you can make a loss. So that's done. Now, I'm not allowed to give you tax avoidance advice these days. Not that I ever, not that I ever did, but what I want to give you is some advice on saving tax in a legitimate way. What I want to talk about this morning are ISAs. Can anyone tell me what ISA stands for?
Independent savings account.
Individual savings account.
Thank you. Right, individual savings account. These have the history of the individual savings account is I think they started off with something called a TESA, which from my notes was a tax exempt. Is everyone leaving? It was a tax exempt special savings account. It had all sorts of rules, and you had to hold it for a certain amount of time, and you could put so much in a year, and those then became a PEP, or rather the savings plan that came next was called a PEP, which was a personal equity plan. Now, personal equity plan started off from my memory at £2,000 a year you could put in. They then jumped a massive to £3,000, still with various rules about where you could invest in the world and with restrictions. And they gave way to the ISA, as we know, an individual savings account, which started life with an allowance of £6,000. It rapidly grew to £9,000. It then grew to £11,500, and now it is a staggering £20,000 a year that you can invest. Simple maths suggests that if you're part of a couple and you're saving for the future, that means you can put away £40,000 a year. In 10 years, you could put away £400,000 a year. That will be sorry?
Not a year.
In 10 years' time.
Sorry, £400,000 total, yes. Plus, with a bit of luck, you could get some growth on that. So it wouldn't be unreasonable to assume that you could perhaps put away something approaching £500,000 in 10 years. Obviously, providing you can afford to do so. But what you are doing is sheltering. You're sheltering that investment from income tax, from capital gains tax for forever and a day. There is nothing that you can do that takes money out of taxation as well as putting it in an ISA. There's a tremendous amount of confusion about ISAs. A lot of the rules have now been taken away. You can now transfer ISAs both ways. You can take cash ISAs and put them into stocks and shares ISAs. You can also do the reverse. You can take a stocks and share ISA and turn it to a cash ISA should you wish to do so. On that subject, in terms of which should you have? Should you have a cash ISA? Should you have a stocks and shares ISA? It's really a question of time, whether it's a short or long-term investment. statistics would suggest that in the last 116 years, stocks and share investments have beaten cash investments in something like 85% of cases over the last 116 years. If you increase that timing to 10 years, then it grows to more like 90%, where stocks and share investments are performing better. Having said that, you may wish to invest small amounts of money into a cash ISA where it's immediately accessible for emergencies and rainy day funds and that sort of thing. Just briefly, there is also now the lifetime ISA, where you can, if you're lucky enough to be somewhere between 18 and 39, excluding a large majority of this audience, but you can invest in a lifetime ISA. A lifetime ISA, the government will actually add 25% to. They'll also take it away unless you use it for purchasing your first house up to the maximum value of 450,000, or you withdraw the money after you're age 60. If you withdraw the money for any other purpose at any other stage, the government will accept their money back. You can buy a home before you're 60, but you've either got to use it. Can I ignore some of these points? Yeah. Right. Okay. So, yeah. Why have an ISA? Because it's going to save a lot of taxation. If you think in terms of money that you earn, you're no doubt going to pay tax on it. National insurance and whatever. What you don't want to be doing with your investments is continuing to pay tax unnecessarily forever and a day, i.e. you're repeating the addition to your income. It's being assessed for income tax or capital gains year after year. It depends obviously how tax efficient it is as to how long you live. But if you're planning to be around for any length of time, then ISA is the answer. One other type of ISA that I haven't mentioned is the rather more specialist ISA, which is the ISA which again has a limit of £2,000 a year, where you can invest in such things as peer-to-peer lending, and that's even ISAable. So there's a great many things that you can do with ISAs now. So yeah, for the long term, an ISA which you top up every year. A lot of people think there are maximum limits on how much you can hold in ISA, but there are many clients that I come across that have got hundreds of thousands of pounds in ISAs now that'll never be taxed. They can withdraw income, they can withdraw capital throughout their lifetime, and they won't be paying any tax on the proceeds. ISAs, as I say, can be transferred. So if you've got cash ISAs that are enjoying all-time low rates of interest, i.e. almost nothing in most cases, and you're going to be holding them for the long term, you could look into what you could do and make that growth more efficient and work better for you. That's really all I wanted to say. So if there are any questions, I'd be delighted to.
You said stocks and shares, ISA, and you said pensions.
Yeah,
Hey, off we go.
that's it.
What's
Your time is up.
What's the difference between investing in a pension, whereas it's put on?
The difference between investing in a pension and investing in an ISA. In a pension, very simply, you will get tax relief on money going in,
Right.
but you'll pay tax on the money that comes out. An ISA is really the reverse, where you put the money in, you don't get any tax relief on the money going in, but you will always get tax relief on the money coming out.
Yeah.
Um,
Well, you've not planned for your inheritance tax situation.
Here we go, Mr. Doom and Gloom.
You've got to be careful.
there's not many investments you can take money out when you're dead anyway, right? But it's
Go straight into the estate. You can't put it.
Yes, I agree.
What Roy's aspiring to there is it loses its tax-free wrapper when somebody
It
dies.
does indeed, yes.
Oh, so if I invest in ISA and I die and I want to pass that on, then
It goes straight into your estate for inheritance tax purposes. You can't put it in trust. It goes straight into the account.
Whereas a pension, you wouldn't.
You can put that in trust, yeah.
A pension can certainly help in that situation. Exactly what the rules on inheritance tax are at the moment, given the current state of the.
Don't ask a bloody solicitor because I know nothing.
And don't. The worry is what the politicians are likely to do to it. So I wouldn't like to answer that right at the moment. Ask me next week.
I think there was a fairly quick U-turn on that, wasn't it?
But I thought it was good. I thought that was very good.
You know, like lifetime ISAs.
Yes.
Does that mean you can only use the money to purchase a house, your first house? Can you use it for something else?
You can use the money for something else, but the government will subtract the
away
money
the
that they
tax.
gave you.
25% back.
They'll take their 25%
You will
back.
only get the 25% through the solicitor as part of the deposit. So if you've got, say, 10 grand, it becomes 12 and a half when the solicitor claims it off the government on completion.
Right.
You know what solicitors are like.
Roy does.
Just think again, if you're saving on a separate note, not just lifetime ISAs, and generalised, you're saving 20 grand and you're thinking, what do I do with it? Do I build on it? I would have instinctively said, I'm going to put that into property. Now, is that a bad thing to have buy several properties with a load of my ISA money? Because obviously you're going to.
20 grand, I do.
No, 20 grand at a time, 20 grand deposit at a time. So if you have 50 grand, you want to buy 2 properties with it.
Well, a lot of
Then obviously
people.
they're going to get capital gains tax on that, but it's your book.
Yes.
Tax for rent. What's best?
Depends how many properties you
This is a
buy
one-to-one conversation.
and how good your accountant is. Because the taxation laws now around properties, and certainly buy-to-let properties,
Yeah.
is getting horrendous. There's a lot of people, accidental landlords, people that have only got 1 property or 2 properties. Come 2020, it possibly won't be worth them doing it.
Where we worthwhile doing buy-to-let?
Well,
You're going to be taxed. The only thing you can write off, the only amount you can write off is 20%, regardless of what it costs you to run that property. So the example I'll give you is you've got a property bringing in £600 a month in rent. So that's 7.2. Now let me make it easier for myself. You've got a property bringing in 10 grand a year.
yes.
The only bit you can write off is 2,000. Well, if your mortgage is £300 a month, that's 3,600 straight away. If the boiler blows up, that's another 2 grand. You're using a letting agent, that's another 12 grand quid. So all of a sudden, you're paying tax on £8,000, but you're only gaining from that property 3.
Yeah.
Does that make sense?
Yeah.
So, if you're not careful, if you've only got 1 property and you have bad tenants for 6 months, you have a boiler blow up, you have something go wrong, it's not actually profitable. And then whatever it makes, because a lot of people say, well, I'll just get the equity gain on it. Whatever it makes then, is it 12.5 grand now, the capital gains? So you now make 20 grand on it, you're going to pay tax again on 7.5 grand when you come to sell it. So in certain circumstances, if you're looking at property as investment, you really need to look at it properly.
11,300 in fact it is.
There's best
Steve.
several properties written out, and then that would make it worthwhile putting money into there than having it nicer.
You've got to think about it properly.
Depends on your attitude to risk, and there's no doubt that if you're borrowing money to invest, as you are in a manner of speaking with buy-to-let properties, then you're introducing an element called gearing, which will increase the risk. It also could increase your return, but it could increase your potential loss as well.
So what's going to happen to the property prices in the UK over the next 10 years then?
That's a
Well, if I knew that, I wouldn't be standing here talking to you.
Come on,
The rugby one.
come on, put your cards on the table.
I think the peaks and troughs
Oh, come on.
are going to get smaller.
do you?
Yeah.
Interesting.
It's going to flatline.
What
There's an awful lot of
pay you?
Another way of saying it.
They're going to fall or drop?
Property prices.
Fall or drop.
1% a year, 10% a year?
Well, if you follow
Minus
the
10%.
historic
Not so much
data,
flies,
then obviously
Fly
they're
like a
going to
brick.
rise.
How much?
I don't know.
Yeah, well, if you follow supply and demand curves, as a consequence, you've got so many houses that are being built, the supply is going to exceed the demand at some point in time, and as houses do, they will drop.
If we hadn't closed our borders.
Now, that's what people said 20 years ago when we had negative equity and all that.
Yeah,
It's gonna-
with supply and demand though, when you look at the availability of stock and things like that, you've still got to factor in affordability. You can have as much as you want. You can have the best product on the marketplace, but if you overprice it, people can't buy it.
That's what I mean.
Do you mean if you buy a new house?
Yeah.
That's what I mean. The affordability of the houses going up is beyond the expectations or the availability of cash for those who want to purchase.
Is
And
there
I
any more
think-
questions to ask me?
What do you think of premium bonds?
It's not as good as
A
James
good way for the
Bond.
government raising money.
Hmm?
A good way for the government to raise money. They'll produce a return over a number of years, but the return you're likely to get is going to be probably not huge.
I've had 3 since I was born and I've not won a bloody thing.
And that's 75 years.
Yeah.
There you are, there's your answer. Yes, probably not the best long-term investment.
Come on,
But
that
like
gets
a lot
one
of
every 3
things,
months.
they all fit in somewhere into an individual situation and in individual circumstances. There is no right, there is no wrong answer. There is an answer that fits each person realistically. It depends on what your expectations are. It depends what your attitude to risk is.
It's the term is the most important thing in a nice situation, isn't it? How long you're looking to invest it.
And surety of return is obviously a key factor. So, I'd like to thank you all for listening and contributing, and to my colleague here for answering all the tricky questions.